good afternoon, and welcome to the first Canaccord Genuity Wealth Management UK and Adam & Company client webinar of the year. That was quite a mouthful. Let's try not to do that again. My name is Tom Becket. I am part of the Chief Investment Office here at Canaccord, and I joined the business, for those of you who don't know, last June when Canaccord acquired my former business, Punter Southall Wealth. My primary role is to work on macro asset allocation, which basically means looking around the world and trying to ascertain what's going on and trying to implement those views into client portfolios, and focusing in on fixed income, or bonds, as some of you might know it, which makes today's discussion, I believe, extremely relevant. And it's also very relevant because what we've seen already in this nascent year, it's only been 2 months in, but we've seen an extraordinary amount of things going on already. There's talk of recession, of interest rates going up, inflation still being an issue, of course, the tragic war still rumbling on in the Ukraine, growing geopolitical angst and pressure on companies as profits start to slow. So we live in a complicated, conflicting, and often contradictory world. So to try and help me through a discussion on what's happening around the world at this point in time, I'm delighted to say that today we're joined by Mark Holman, who is a fixed income manager at 24 Asset Management. Mark and I have known each other now for getting on for 15 years as we've invested together. And one of the good things about my old business and my new business, and indeed Adam & Company, was we all had a very positive view on 24 Asset Management and their ability to manage fixed income assets. And you'll learn today why, because 24 Asset Management has basically been the shining star of the European asset management's fixed interest industry in the last decade or so. And Mark would be too humble to say this, but I think he's just about the best commentator that there is on fixed income around the world. So Mark, thank you very much indeed for joining us. It's an absolute pleasure to see you and to try and help me wade through the difficult world that we currently live in. But I think we're going to give everyone a positive view today on the world of fixed income. But let's start with the economy. And there's lots of talk out there, a lot of which is still very negative. And if you think back to when we wrote our Outlook documents in November and then sent it out in December of last year, we were talking about an economy which back then was growing very fast, but likely to slow this year. And there was talk about hard landings, soft landings when things look better. And so far this year, there's been talk of no landing at all. It's complicated, isn't it? But where do you stand on the current economic situation around the world? Thank you.
Thank you, Tom, and thanks for the lovely introduction. I can only go wrong from here. In terms of landing, of course we're going to land. It's impossible not to land. But when we look at what happened throughout last year, markets were starting to price in some fairly bearish scenarios. Markets were getting a long way ahead of themselves. And I think as we went through the year, getting into Q3, Q4, the market's perception of a hard landing was becoming very real. Now, since then, I think it's really important to note that some of those tail risks, some of those uncertainties that the markets were worried about, they have been removed. There's absolutely no question as a starting point that the risk situation today is better than it was in October. So in terms of hard landing, soft landing, I would say that, no landing can't exist, by the way, but I would say that the chances of a soft landing have materially improved during the course of 2023 so far. The hard landings are typically synonymous with high levels of unemployment, a poor labour market. When people have less earnings, they can get through. When people don't have a job, they can't get through. That's been a really big differentiator here. So we have a very good, solid backdrop for a labour market, which in my view means a hard landing still sits there at around about a 20% probability. So if I was to give you a synopsis of where we stand today, I'm somewhere between soft landing, which is landing without recession. So definitely got slowing growth, and it could go towards zero, or a soft-ish landing where we have a very minor recession briefly. So both of those outcomes, I think, are materially better for markets than what we were pricing in back in Q4 last year.
So in very simple terms, that is good news. And I think that people like yourself and myself and anyone who does our job, and I'm not getting the violin out, we have to recognise, and everyone on the call has to recognise, that we live in a very complicated world, and actually there's no historical modelling for the sorts of environment we've been in for the last few years of the pandemic situation, the government spending on trying to recover from the pandemic, what we've been able to do with regards to high levels of savings through the pandemic and that pent-up demand. It's very difficult to model and have a certain view at this point in time, but we would agree at Canaccord with your own view that things look better now than they probably did a few months ago, and that's been reflected a bit in asset markets, as we'll go on to talk about, but could lead to further gains, which is, of course, what we want to see after last year was a very miserable year. But let's just think about it in terms of very simple building blocks for everyone on the call. There are probably three big places around the world, aren't there, that matter for financial markets and for the economy and for inflation, things like that. The US, still the world's biggest economy. Europe, which is a big economic bloc and has been for some time the sick man of the world. And of course, China as well. And what we're seeing at this point in time, to add to the conflicting and sometimes contradictory world that we live in, is they're all doing different things at the same time. So how would you break down those three building blocks to try and put together a jigsaw for us all to understand?
Yeah, all really important, Tom. And I'm going to come back to things are better now than they were. Let's start with the US. Fears that the Fed would have to go a long way in terms of raising rates, that inflation was never going to come down. Well, I know the recent data may not have been as perfect as we would have liked, but it's definitely a lot better than it was in October last year. So the US economy, great, still got some growth, terrific labour market, still one of the best labour markets we've ever had, lots of openings for new jobs still. I think that the US is actually obviously experiencing a slowdown, but way better than could have been expected last October. If we look at Europe, what was your biggest worry about Europe? It was all about energy and the supply of energy, and would they not get enough natural gas, and were there going to be closures? Well, that hasn't happened. A combination of increased supply, more efficiency, warm weather, that tail risk has disappeared. In China, your last one there, it's reopened. Thank goodness for that. The COVID zero policies have been put to one side. So all three of those materially better than where we were in Q4 last year. And that's why the markets are in better shape and we have more visibility on what could happen today than we had back then.
More visibility, which is good, and I think positive dynamics behind global economic growth. But you and I have worked, I'm not going to say how many years you and I have worked individually or all together, but it's been a number of years. There's no such thing as a free lunch, is there? So economic growth is better than we were suspecting only a few months ago. Part of the reason for expecting inflation to come down this year considerably was a slowing of economic growth. So where do you stand on the inflation dynamic? That's probably the thing which matters most to everyone on today's call and everyone in today's society. But if economic growth is not going to fall as much as we're expecting, does that mean the quid pro quo is that inflation stays higher for longer? Or what would your view on that be? Thank you.
I think it's very difficult to give you an accurate projection on inflation, but what I can say with confidence is it will come down. I'm very sure of that. We have a 12-month series. We know what the data looks like in that 12-month series, and it will come down over the course of this calendar year. So that's one bit of good news, if you like. The bit that I'm more concerned with, I've been worried about inflation as a concern for markets for several years now, is I don't think it's going to come down to a level that suits the central banks. That means the 2% type levels that the Fed, the Bank of England, the ECB are targeting. I don't think we're going to get there. I'm worried about that, and consequently, I'm worried about the neutral rate as well. I think the neutral rate will have to go a little bit higher as well. So I think there's higher inflation for longer, maybe quite a bit longer. That doesn't necessarily have to be a bad thing if it's controlled. If we got down to circa 3%, for example, if the neutral rate was 3%, it doesn't really matter as long as we're getting paid for having 3% inflation and getting paid for having a 3% neutral rate. So that, I think, is the key thing, is where are interest rates relative to what inflation might be and what the neutral rate might be.
Yeah, I think the neutral rate is a term that you and I use in very simple terms for clients on today's call. A neutral rate is where effectively interest rates should be that it's no longer creating inflation or causing deflation. And much like many terms central banks use, no one really knows where that actually is, and that leads to policy errors on both sides of the equation. We'll come back to potential policy errors in a minute. But in very simple terms, you made 2 points there. It's the direction of inflation. Well, we're going from sort of 10% around the world to 3%. That's obviously good news for all of us. I mean, some of us would, more skeptical of government, would say that I wish I had a 10% inflation rate the last year. It seems quite a lot higher than that, but that's just a point we can put to one side. And I think the second point you come to, and we'll come back to this later, is what are you being paid for that? And I think that's the key point about fixed income investing, which will be the main course of today's discussion towards the end of today's call. But let's just think about the situation as we see it now for those central bankers. So we know that interest rates have had to go up to try and quell some of the inflationary pressures that we're seeing. Now, some of the inflationary pressures were beyond the control of central bankers. The Russian tanks rolling over the Ukrainian border, as an example, that led to massive spikes in commodity prices where, with the best will in the world, Andrew Bailey in the Bank of England, Jerome Powell and the Federal Reserve, they couldn't control those issues. So they're trying to quell demand, aren't they? But one of the things you'd say right now is their ability to quell consumer demand, particularly in the US, is not really working very well, is it? The consumer remains in pretty good shape. And as a backdrop for economics and for the financial markets themselves, that's probably good news, isn't it?
Of course it is, absolutely. Now, the consumer, and there's lots written about this, whether it's the consumer or corporates, actually, they've actually saved quite a lot of money during the pandemic. So their corporate balance sheets are in good shape. The consumers' bank balances were in good shape. Now, that saw them through some very difficult situations. And yes, they may well have spent some of their excess savings, no question about that. But all the time that the consumer has a job, they can keep going. And what we are seeing alongside this is wage inflation. So although central bankers don't like wage inflation, a little bit of wage inflation is good for the economy because the consumers can keep spending. The US economy is 70% driven by the consumer, same as the UK economy, 65% driven by the consumer. So if the consumer's got a job and the consumer's getting a pay rise, we're not going to have a hard landing. Yes, we may have a slowdown. Companies may make less profits. We may see slower GDP. But from my perspective as a bond investor, I don't mind. I just want companies to be solvent because solvency means I get my coupon and my principal on time. So that's actually not a bad situation for me.
No, absolutely. And we'll come back to talk about the fixed income equity debate towards the end, because I think, again, that's a very key point behind today's main course of talking about the opportunities ahead for fixed income. So in very simple terms, where are we now on interest rates and what central bankers should do around the world? And let's focus in on the UK and be a little bit parochial, because I'm sure everyone's asking where UK interest rates might go, and I'm not sure the Bank of England knows, so I won't hold you to that specific view. And also, what's happening with regards to the US, the Federal Reserve and interest rates, because that does still very much set the tone for what's happening around the world, doesn't it?
Yeah, it definitely does. But let's start with the UK, and let's start with the Bank of England. They are extremely difficult to read, and I think partly Andrew Bailey's messaging has been very difficult to interpret. He sends different signals, and even from my perspective, I call myself a central bank follower. Very difficult. Today's FT article saying don't worry about future rate rises. Previous one, we might have some more. He seems to like this element of surprise. I don't know why, but from our view, we're at 4% today. I think if you want to achieve a soft landing, your policy must direct markets to a soft landing. So you've done aggressive cutting, so emergency cutting, the emergency brakes are going on, but then you must slow down. So in my view, we have in March, we'll have the next Bank of England MPC meeting. We're going to go to 425. We might go to 450 with one more after that. I think then they're done. We all know that the pain that mortgage rates are causing onto consumers now and onto businesses as well. When those come for resetting, it's going to be quite expensive. So I think they should really be waiting and seeing, and that 4.5% would be enough. Obviously, that the whole market looks at the Fed and what the Fed's doing and what the FOMC are doing. And again, we have a meeting at the end of March coming up, and I think they're going to continue with 25 basis points. Again, they did the sharp increases. Now let's slow it down. The market tends to think that within 3 to 6 months of the last hike, we'll have a cut. And the Fed does not want to send the signal that they're going to have a cut. So doing small 25 basis point increments. So the last one was 25. The March one will be 25. The one in May is going to be 25. I think that will dispel the chances of a rate cut in the US later this year. So that gets the Fed to an upper bound of 525. So I think we're almost there. We're almost at the top of the interest rate hiking cycle, and then they're going to wait.
Yeah, you raised some interesting points there. And it's just very interesting. I think everyone on the call hopefully recognises this. It's a very different environment to that which we saw in the decade before, which in my previous role at Punch Stuff, what I described as the easy tens. We may look back on the last decade and think, God, there were a lot of crises and a lot of volatility, and it was quite hard in financial markets. But in comparison to what we've seen in the last 3 years of what I've called the turbulent 20s, the easy tens were just very easy by comparison. If you think back to that environment which we were in, you saw low but positive economic growth, you saw low but positive inflation, you saw low but positive interest rates, and you saw high asset market returns. Now we're talking about interest rates of 4 or 5%. It is just a completely different ballgame, Mark, isn't it, when it comes to macroeconomic policy and what's happening in fixed interest markets, which we'll touch on in a minute, but also creates more opportunity. But I think one of the important things that everyone should note, whilst taking into account how much has changed from the last decade into this decade, is if we think back to the first decade that I worked, and I started working in the very early part of this century, interest rates were always around 4 or 5%. In fact, there was a period of time beforehand, Mark, when you might have been working when interest rates were substantially higher than that. But we shouldn't necessarily be terrified of a 4 or 5% interest rate situation. And I think the thing to note from what Mark is saying about interest rates, and you've all heard about quantitative easing, in very simple terms, for much of the last decade, the tide was coming in for investors. And the tide was coming in for investors because central banks around the world had interest rates at zero, and they were purchasing a large amount of assets through quantitative easing, which pumped liquidity into the financial system and made assets more expensive. Now, what we've broadly seen, and this has been reflected in the performance of portfolios in the last 18 months, is the tide going out. And really what we're all looking for, Mark, is when the tide might stop going out and when the tide might then maybe start coming in at some point. And what we're saying is, the perspective of the tide going out, we're nearly at the spring tide low, aren't we? Central banks' policy for interest rates are probably nearly as high as they're going to get, aren't they?
Absolutely. I think we're going to see the peak in rate policy, certainly from the US and from the Bank of England, in the first half of this year. So that means in the next 4 months. So that's not very far. And I know it's very difficult to judge the day the last hike comes through, but I don't think that really matters. I think as long as you're invested at the point when the central banks reach their highest level, I think you're in good shape. And yet don't try to be too cute in this last phase. Certainly from a bond perspective, starting to own bonds near this point historically has always made sense.
And as we're going to talk about in a minute, mathematically, it's almost impossible not to make money from current bond prices and current bond yields. But we'll talk about that in just a minute. I mean, just to bring us to where we are now before we talk about markets and how we can make money going forwards from fixed income. As many of you now know, I'm really quite fundamentally got a simple person, but I think investment is always in danger of becoming overcomplicated. So at Canaccord, what we do is we break down the range of outcomes into 5 different building blocks. We have the economic situation, we have what's happening with inflation, what's happening with interest rates. In a minute, we'll talk about 4 and 5, which are asset valuations and investor sentiment and positioning. In terms of the economy, I think we would absolutely agree with Mark. The situation remains conflicting, contradictory, confusing. But I think that the very simple message is that the economic outlook probably is better now than we assumed it would have been 6 months ago. And that's undoubtedly a positive. With regards to inflation, there is absolutely a chance that inflation proves stickier through this decade. And I think Mark and I both agree that with a combination of decarbonisation, deglobalization, which we haven't got into on today's call, but we could do, the increasing lack of trust between governments around the world, that's also going to contribute towards a higher level of inflation. But inflation is going to come down from the extraordinarily high levels we've seen in the last year. And with regards to interest rates, I think we're unified, Mark and I, in our view that what we'll see is interest rates peaking somewhat near here. So the most important thing from all of this intellectual discussion is, well, how can we make money from this? And this is why fixed interest markets, we both believe, are very interesting. And I don't want to sit in here and come across, I'm sure Mark doesn't either, with a rampant optimism, which many of you will know from from dealing with previously, is not my natural disposition. I think what we're really arguing, Mark, is that in the last year and a half, which has been about the most painful experience possible for fixed interest markets that we've seen through history, what we've done is we've wiped out the excesses. We've made valuations go back to something more sensible. And in effect, if we think about the last 13 years of being a period of central bank hyperactivity and distortion of interest rates at very low levels, what we've really seen is a return back to the normality we saw in the first decade of the century. That's basically the case, Mark, isn't it?
Absolutely, no question. When interest rates are very low, making money in fixed interest is far more challenging. You need to have cheap credit spreads. You need to be moving around quite a lot. And the cost of not being invested is low. So therefore, very easy for investors to leave the market and do something else. And that's really why when interest rates are close to zero, so much money pours into risk assets to try to make up for the fact that they're getting nothing from risk-free. Now, when we have much higher rates, which we do, and I know you're going to go into the kind of spectrum of things that we can look at. Now we've got much higher rates. The cost of not being invested is high. And the returns that you need to expect from every other asset class must be risk-free plus whatever you want to take your risk buckets in. So when we've got much higher rates like we have now, the chances to make money are much, much higher. So, that makes my job significantly easier. Now, you say that it was easy during the 2000s because it was a 2010s, it was a lovely decade. But I can remember in the late 80s, early 90s when we had double-digit interest rates, almost impossible not to make money in fixed income because you're getting such a high yield.
Absolutely. But I think that we just have to remind everyone on today's call how much the game or the investment backdrop, is probably better terminology, has changed in the last 15 months. If we think back to November 2021, which was probably peak in the lunacy of valuations in fixed interest markets, we were sitting there looking at government bond yields that were basically around zero. I mean, you could do 20, 30 basis points in some cases, but broadly around zero, matching interest rates. High quality UK investment grade corporate bonds, those sorts of money good investments where there'd be a backbone of a private client portfolio. They were yielding roughly 1.5% and the lowest rates of yield probably ever observed before in history. And even the more speculative end of the credit markets, the sort of more high yield corporate bonds or junk bonds, if you know your terminology, they were yielding somewhere between 4 and 6%. Again, the lowest ever yields in history. In fact, we came from a world quite recently, Mark, didn't we, of the lunacy of negative interest rates, which meant that sometimes you lend money to a company and pay them for the privilege of looking after your money for you. That's how distorted the world that we lived in was. But the game has very much changed. And as we sit here today, Mark, we're looking at government bond yields with roughly a 4 to 5% yield in most cases. In the UK, it's more like 4. In the US, you can find government bond yields at a very short maturity with more like 5% yields. UK corporate bond yields have broadly quadrupled from 1.5% to 6%, and high yield bonds would be having a yield of anywhere between sort of 7 and 10%. That might sound very attractive by comparison to where we were, but if you took it back 15 years, we're just going really back to where we used to be, Mark, aren't we?
Well, if we look at the whole period, let's say from 2000 through to 2007, that's exactly where we were on average, Tom. We probably had, on average, base rates something like 5% in the UK, so government bonds around 5%, add a couple of percentage points to corporate bonds, and then add a few more basis points on that for the higher yield. So, yes, this environment now reminds me very much of that environment in the early 2000s. And I think from a bond investor standpoint, much easier to make sensible returns. And I think from a general investor standpoint, you need to really consider whether your investments in other asset classes are going to do better than the lower risking fixed interest parts of the world.
Well, I think that's a very important point. But let's talk first, and we'll come back to that, because I think that's absolutely what people should be considering when it comes down to their own asset allocations and what their advisors might be telling about what they should do with their portfolios. But because fixed income is a situation where you have quite a lot of downside. If you're wrong, you could end up with nothing if the company goes into bankruptcy. And the upside is relatively limited. It's limited to the recovery back to the par amount and the yield you're going to get, which we think are currently quite attractive. But we could be wrong, and defaults could pick up very markedly from here, couldn't it? But you said something interesting earlier about companies' balance sheets being in great shape. Perhaps you could flesh that out and put further into context why you're perhaps more relaxed than most about the outlook for corporate defaults.
Obviously, corporate defaults, if you're investing in a company, the worst thing that can happen is they go into bankruptcy. That's the real negative. But corporate defaults, in my mind, are not going to be that negative without a hard landing. So I think all the time that the consumers and the corporates are in good shape, a hard landing is what's going to give you the ingredient, I think, to give you more defaults. But let's look at corporate behavior during the pandemic. They hoarded cash. They hoarded cash in big sizes. They then termed out their debt at extraordinary low levels of interest rates. So the repayment of debt is something that is obviously highly important to bondholders. And the debt service coverage ratio, as we call it, i.e. the amount of profits they make relative to the amount of debt they have to pay, rarely has looked this good. So corporates have done very smart things in stabilizing their balance sheets. And in fact, during 2022, we observed the lowest levels of defaults that we've ever seen. So less than a 1% default rate for US high yield and for European high yield. It's extraordinarily low. So I think that default rate, in my mind, will stay low without some kind of a crash. I think that's a really important backdrop. And also, I think you've got to look at upgrades versus downgrades. So how many companies are getting upgraded versus downgraded is then a nice early indicator towards that default rate. So I think that default rates, whilst obviously a problem for some, are going to stay low. But secondly, I think important for your listeners on the call today, really important, is more than 95% of companies who default from a triple C rated, triple C rating rather, and the other 5% broadly default from a single B minus type rating. So if you didn't know anything about bonds and you were worried about defaults, just don't buy those lowest rated cohorts. Stick with bonds that are strong single B, double B, investment grade, because they're not going to default. Yes, they may have lower earnings. Yes, they may have tougher times. Yes, they may have pricing power issues because of inflation, but they're not going to default. And bear in mind, in fixed income, we don't mind if a company makes 1 billion or 2 billion. We just want to get paid our coupons. So we want stability. That's all we're looking for. So, I think you can get a bit too hung up with defaults. And I think if you're focused on the default rates, because you're really investing at the lowest part of the risk spectrum, the high risk part of bonds, which is the deepest part of high yield. And when interest rates are as high as they are and yields are as high as they are, you don't need to do that. Now is not the right time to be fishing in the lowest rated part of the fixed income spectrum, because we know the economy is going to slow down, because we're pretty convinced about that. The default rate, of course, will pick up a little bit, but not materially. So just increase quality. Increase your quality of your portfolio, steer away from those lower rated buckets, and then you don't have a default problem.
No, we would absolutely agree. And that brings us on to the last bit of today's discussion about the portfolios themselves. And if you think about the fixed interest portfolios that we run at Canaccord, and by implementation and implication, the fixed income allocations in our clients' portfolios, what we've really tried to do in the last 7 months is be very, very selective and be up in quality and focused in on those specific companies and sectors where we believe that they can continue to operate sensibly, refinance their debt, and pay us through that whole process. It might sound very simple, but to do that, Mark, does that mean we're giving up a lot of return? Is that the wrong place to be looking? Should we be taking more risk? If you think about the overall fixed interest model we run and a yield of between 6 or 7%, does that sound about right to you?
Tom, absolutely. The time to take a lot of risk in fixed income is when the economy is starting to boom, when companies can repair their balance sheets, they've got excess cash coming in, and all the worries of default and downgrades are going away. Then you can fish in the most risky parts of fixed income. But when the economies are slowing down, interest rates are going up, the simple thing is, and it really is simple, increase your quality. Makes complete sense. Yields have been rising. 2022, as you said at the outset, we've seen yields rising really quite materially. So you're not giving up anything. Just increase quality, fish in the right sectors that you're confident with. Try to buy companies that have pricing power so they can pass on those inflationary increases to their customers, and you'll be absolutely fine. And I think the yields that are on offer now are super attractive for achieving many of the goals that investors on this call are looking for.
No, I'd absolutely agree. And if you talk about a fixed income opportunity set that's yielding anywhere between 6 or 8%, or you want to take more risk, and then that's entirely, we would guide towards a more balanced outcome. But that's an interesting situation from a mathematical perspective and comparing against other asset classes, as you mentioned earlier, because let's just say the yield is 6.5%, and that's your return. None of this is a promise; it's just being used as an example. I hasten to add, but it is 6.5%. I mean, that's comparable to the long run sorts of returns that we've seen from equities, isn't it? And when it comes to fixed income, Mark, as you said, we're not looking for profits to boom or for takeovers to take place. In fact, we don't actually want that to happen quite often. It leads to bad corporate situations. All we really want is companies to carry on, keep on paying their interest on their bonds, and give us our money back at the end of it. It's really as simple as that, Mark, isn't it?
Well, I like the analogy with equity type returns here, because, and I'll put it, perhaps even more simply, if you bought a 4-year bond yielding 7%, after 4 years, you've made 28%. Can you find me an equity that's going to give me a 28% return in 4 years with a very, very high level of confidence?
Right now, absolutely not. And I think that's the reason why we've seen a massive increase in demand for fixed income across the UK wealth management industry and across global financial markets too, because the situation has just simply changed with regards to the relative return. In the last decade, there's been a concept of TINA, which has been there is no alternative to equities. Actually, now fixed income does provide an alternative, and I would go as far as saying that bonds are back. And I said it's not a competition between how long you and I have worked, Mark. I think you do ring that one just, but we're very good friends as well, so we won't mention that again. But just in terms of putting into context everyone on today's call and people who might be viewing afterwards, you've seen a lot of different economic cycles, a lot of different credit cycles, a lot of different financial market situations. How would you put today's risk and reward opportunity into balance? Because yes, there are risks out there, obviously. We're being better compensated for it. And just as there were risks there 5 years ago, we weren't necessarily being as well compensated for it. So how do you put that mix together to sum up and conclude today's opportunity set ahead in fixed income?
Oh, that's a tricky one, Tom. Thank you for that final...
I did say we were good friends, Mark, but there we go.
We were, yeah. No, but seriously, every time in my 35 years in bonds, every time I've been confronted with 10% yields, I've always said to investors, go and have a look at fixed income. Go and have a look. See what you think, because 10% yields don't come around very often. And if you don't like the risk, don't take it. But every time we've seen higher yields, it's been an opportunity. And usually, though, when we've had these kind of higher yields, there's been something pretty dangerous out there, something that, is enough to make you slightly frightened. That's why the yields have gotten this high. This time round, we do have much higher yields. They might not be 10%, but I think you can get high single digits without taking too much risk for sure. So you're getting, I think, really high yields, but with the backdrop of an economy that's just slowing. It's just slowing. It's not an economy that's about to have a crash or a hard landing. We're not about to have this, a global financial crisis. We're not about to have COVID. We're not about to have something else that we don't know about. In the marketplace, making life very difficult. We've got these yields now, actually, with an economic environment that is better than we thought it was back in the fourth quarter last year. So on a risk-adjusted basis, I like where we are now. This makes a lot of sense to me. Now, you might not be buying at the ultimate high yields. You might not be buying on the day that the last hike comes through on the Bank of England. I don't think that matters, because we're long-term investors. We're locking in long yields for longer, and we'll achieve the goals that we're looking for in our portfolio. So I like this environment, Tom.
And of course, just to finish off, it's the first time we've been able to say that with anywhere, I wouldn't say certainty, but with the sorts of convictions we can now, absent a few months in 2016 and a few months in 2020. The structural opportunity set in fixed income, from what Mark said today, and I absolutely agree with him, as do we all at Canaccord, has materially changed. And I think this is a really good opportunity for all of us to think about our asset allocation and wonder whether or not bonds are back, and it's time to reconsider them after what could have been a very long hiatus. Mark, thanks for your time today. As always, that was very entertaining and extremely informative. And I hope we are still friends, despite my difficult question at the end. Thank you.